Okay, great. Hello, everyone. Thank you so much for joining us today on this call. We really appreciate it. As we sort of get started, we wanted to say thank you from Natixis to everybody joining, and really appreciate all the business that we get to conduct with all of you, and appreciate the partnership. We hope that you'll find value in today's call and find it interesting. And we look to do sort of more of these in the future. So if there are any kind of requests or insights into different topics, whether it's rates, effects, economy, markets, let us know, give us your suggestions, and we'll be happy to try to incorporate them in future calls. Today, basically, we have two speakers. We have Chris Hodge, who is our head economist, as well as John Briggs, who is our head US rates strategy. And they will have roughly about 10 to 15 minutes to kind of go through their notes, and then we will have a Q&A session. Chris has been with Natixis since 2023. He joined us really from the New York Fed, where he was a principal economist and also in charge of emerging markets. Prior to that, he roughly spent about 9 years in the private sector, mostly on the buy side. He brings about 15 years of experience covering macro economy markets, and has been frequently featured on various different financial media, such as CNBC and Bloomberg. John Briggs has joined us very recently, just in 2025, from NatWest RBS, where he was the head of US rate strategy and global head of strategy for about 15 years. Also very frequently featured on Barron's, Bloomberg, and other media. You guys can see them in publications on TV as well. So very happy to have our speakers today. I'll just make a final note that if anybody would like to ask any questions, please go ahead and post them in the Q&A section, and we will go ahead and present them to the speakers afterwards. If anybody's interested in asking a live question, just raise your hand and we will unmute your line and put you on video, and you can go ahead and have a conversation with our speakers today. So with that, thank you again for joining us, and I will pass it on to Chris to start the call.
Thanks, Simon, and thanks to everybody for joining. I just want to run through briefly what we see as the potential outcomes of the Fed meeting tomorrow and how that plays into how we see the economy evolving over the next year or so. So the interesting part isn't the outcome of tomorrow's meeting. Obviously, 25 basis points is pretty much priced in at this point, and if there was going to be a jumbo cut, we think that probably would have been telegraphed in advance. The more interesting aspect is going to be getting some more color on just how much the balance of concerns has shifted from preserving the labor market to combating inflation. Now, this is one of these meetings where the Fed's going to release its summary of economic projections, better known as the dot plot, and we have some personnel changes as well. We have Stephen Myron, who's the chair of the Council of Economic Advisors. He's on loan from the White House and was not placed at the Fed to be hawkish. He's auditioning for a role, either a full-time role in the Fed or maybe even Fed chair. So they may need to have to rescale the axis on the dot plot because his projections are going to be so low. But our base case for tomorrow is that the Fed dots are going to show multiple more cuts for this year, and the Fed marking to market their expectations for 2026 with the policy rate approaching about 3%. And I think the communication from Powell is going to signal that the policy is going to fall, but the path towards neutral is not preset, and it may not be direct either. And tomorrow's move is more of a recalibration than a promise to eventually provide some accommodation. So the Fed's being pulled in multiple directions at this point, with both inflation and unemployment on the rise. You have the dovish camp at the FOMC that thinks inflation is going to be transitory and that the labor market's in trouble. And you have the hawks that think that given that the inflation target or that inflation hasn't been a target in 53 months and is on the rise, warrants more concern. Both can make very credible arguments, but I tend to think that inflation will continue to be a concern, and that even though we'll have some labor market softness, we're not going to have unemployment spiral out of control. As for inflation, a lot of the focus has been on tariffs, and the pass-through to consumer prices has been noticeable, but the effects of the tariffs seem to jump from category to category every month. And this is to be expected given the very uneven application of tariffs and the varying ability to stock and restock inventories on a timely basis. And looking forward, I think we're probably going to be looking at much stickier inflationary dynamics for a couple reasons. First, the Fed's blueprint that we've heard very often from Christopher Waller is that tariffs should be transitory. They should be a one-off event. for an individual product, that's probably true, strictly speaking. But a month after month of series of one-off events is indistinguishable from the perception of broader price increases, which means that the expectations for inflation have a greater chance of becoming embedded. Second, though the higher prices could be corrected via demand destruction for goods, we're now getting elevated service prices as well, which is going to be concerning for the Fed. As far as the labor market's concerned, sure, we've had a string of bad news, especially from payrolls. But if you look at ratios instead of levels, the story still isn't great, but it's not really flashing any red flags. The vacancy rate, the hires rate, the fires rate, the unemployment rate. These are what the Chicago Fed President Austin Goolsbee calls the four horsemen of the labor market. These have not deteriorated. So while companies are hesitant to add to payrolls, they're also hesitant to let workers go. And with profit margins still being pretty fat, bank lending still holding up, and aggregate demand being pretty resilient, businesses are going to continue to hoard labor however they can. So despite the bad news for jobs recently, wage growth has showed us that labor market slack is still very limited. And then I think that the economy can muddle along with a break-even payroll rate for 20 to 40,000 for a while longer. So I do think that the Fed eventually is going to bring its policy rate down to about 3% as the terminal rate for the cycle. But that 2% inflation target is going to seem more like an aspiration than a target, and is going to come in with something closer to a 3 handle throughout 2026. So I want to toss it over to John at this point to get his take on the market dynamics, not just from tomorrow, but what we see going forward.
Thanks, Chris. So as Chris kind of gave us our base case for what we're seeing from the Fed, I actually think that that outlook is fairly well priced at this point. Though recently we've seen a little bit of a pullback, mostly through the yield curve, but also looking out towards the terminal rate, which I think is really going to be the important part of this meeting. You know, what's, as Chris mentioned, what's the forward path? Where's the Fed going over time as far as influencing where we think the rate market's going to go? But you know, just using, say, late 2026 Fed pricing for an example, it hit a low around 280. Now it's backed off closer to 290. So I do think there's some room that even if we get what we expected to see, a little bit of a re-steepening rally under the main scenario. But I do think for a more significant move, at least for the bullish side towards the downside in yield, say taking twos down to 3.25, I think this will take in a weaker payrolls in addition to just the Fed meeting. So when we think about the potentials for surprises, in the case of a dovish surprise, say where the dots project a lower terminal rate than expected, or for 2026, consensus seems to be settling around the reduction in the dots for around 50 basis points, but say it goes to 75, or some longer run projections that think the Fed is not going to go just to neutral, but be more accommodative below what's called neutral 3.25, significantly below there. I think that is really what we're looking for as far as it will be quite a dovish surprise. I mean, in this case, I think the bull steepening we could see could target around 330 in 2-year yields, 340 in 5-year yields. I'm not as bullish on the long end, but I think in this scenario, you could see 10s break 4%, potentially to 390, a little more on the curve later. When it comes to a hawkish surprise, you know, if you get something that is a non-committal Fed, or a Fed that is going really fully data dependent, or taking out insurance, say, against downside risks in the labor market, but not committing to any future path, never mind the next couple meetings, you don't see a big change in the dots, maybe even if it's just contextualized around uncertainty around tariffs and inflation, I think that you could get twos moving up towards 375, fives 385, and 10s getting near 420 support. Now, I do think those levels are a little bit more on the extreme end of forecasts, and I think that given our medium-term views on the Fed and the economy, we do think those would be used as good levels to fade. But I just don't want to underestimate, especially initial levels, when I think the market certainly has a rate cut cycle coming in. Market has a feeling that if anything, Powell could surprise more dovishly than hawkishly. That I think that the hawkish reaction could actually be more, even though it's probably a lower probability. I mean, I have to say that I'm also in that camp. I do think there's a greater chance of a dovish surprise than a hawkish one. I mean, as Simon mentioned, I've been around a little while, but I can't remember Powell surprising hawkishly with the backdrop of a weakening labor market, or even if it's just determined a softening labor market. So given that, as well as the recent correction, we're actually holding our current recommendations into the meeting, most of which were put on back in July. Long twos from the 390 area, curve steepeners, specifically 3s, 10s, but we like 5s bonds as well, and short 30-year swap spreads. What I'll just add more broadly is looking further down the road. I do think that we've done a lot of the near-term heavy lifting when it comes to the duration rally. So, for example, if we get down to 3.25 to 330 in the front end in twos, we'll likely turn neutral. But we do think that there is a lot more to go as far as steepening out the curve as the cycle plays out. It's a very popular trade. We've seen a pretty good unwinding lately, and hopefully that's cleaned up some positions. But I actually see the steepener working out over 3 different time frames. First, short term, you got the normal curve steepening that's associated with monetary easing cycle. That's being accentuated by the fact you're easing into still above target inflation. Medium term, I do think that there's going to be ongoing, although sporadic, pressure on global long duration sovereign bonds, perhaps for all idiosyncratic reasons across different geographies. But I do think that that's going to be an ongoing pressure, and I don't think the US is going to be immune from that over the medium term. And then long term, I mean, I believe that we are shifting into a new regime where we are going from a regime that was post-global financial crisis to COVID. And then this is a new story. It's essentially really a term premium story. Higher volatility in the inflation data. Markets can need to be compensated for that. More inflation-prone global economy, whether that's lower labor force growth, deglobalization, tariff risks, more fractured geopolitics, overall more volatile environment geopolitically, and even domestic policy, fiscal policy, tariff policy, and then the risk of a more politically motivated Fed chair or just a generally market perception there could be a more potentially compromised Fed when it comes to independence. So all those point to what, for me, increased term premium. And simply put, in my mind, 50 basis points is just not enough compensation for 10 years, to extend from, say, a 2-year note to a 10-year note. So I think that if you believe the Fed is going to head to neutral around 3%, even though I'm sure that 10s will rally below 4%, for me, I just don't see much interest there. And I think that even in a more stable environment, a steady state or communicated 25 basis point cut over a series of time, I do think over time the curve will bend steeper. So I will say between the two, previously had higher conviction on duration, now getting more neutral on that, but still have strong conviction on the curve. So with that, I will pause and hand it back to Simon, see if there's any Q&A.
Great. Thank you so much, guys. Really appreciate it. A question that I think you've answered a little bit of the sorts towards your end of your remarks, but how much lower do you think the 10-year will go below 4%, and how feasible it is for it to stay there for a longer period of time, and really what will it take for that to happen?
Yeah, I mean, for me, I think again with those different time frame views on steepening, I think it's going to take the market perception that we're not going to neutral, that we're going to have accommodative policy. So I think it's less of a risk in the near term and more kind of down the road. If we do see a sharper deceleration in the labor market, or a perception that said sharp deceleration in the labor market is going to be disinflationary enough to combat some of that sticky service price inflation that Chris was talking about. So I think that for us, Chris's forecast of cuts to 3% by the middle of next year, that doesn't give you enough juice to say that beyond perhaps intraday rallies or curve unwinds or things that we've seen, that you're going to get 10 sustainably below 4%. I mean, I'm sure they'll trade below there. I just don't have any interest in them there. But if you start talking about a Fed that needs to go to 2.5%, 2%, then yeah, it's going to get dragged down by the rest of the curve. I would still rather be positioned more to the front end. And I still think that steepening bias will hold, but getting into a prediction or market's expectation that we're going to have to move into some level of accommodation will kind of pull it down through there. But I think that right now with the inflation outlook, and Chris can follow up on that part, I think that that's a higher hurdle right now.
Got it. Thank you for that. A question around inflation and tariffs. Will we see more pass through into inflation, a tariff pass-through into inflation, and will the Fed start being concerned and adjust their monetary policy?
Yeah, I do think we're going to continue to see that tariff pass through. We've had 3 straight months now of core goods inflation accelerating. And given the huge amount of imports and inventory restocking that we saw in the first half of the year, that's only starting to be run down. And as businesses need to restock at higher prices, these costs are going to have to be passed along either to consumers or to be eaten into profit margins. Now, the data that we saw today from import prices show that we haven't seen exporters eating any of these costs. So these costs are being borne domestically, and we have tariff collection for FY25 running about 100 billion above where it was a year ago. So businesses are cutting the checks to the government for this. We've seen margins compressed for wholesale trade inflation recently. So I do think that businesses can only accept these lower margins for so long before they have to start passing them on. I do think by the end of Q1 2026, we're going to see that fully pass through, and for goods inflation to stay high, but not keep going any higher. And the way that these tariffs have been implemented on a rolling basis means that we're not going to have any 1 month where we're going to see core goods prices spike. We're just going to see elevated levels for the next 2 quarters.
Got it. So, I mean, this kind of analysis is what you already have priced into your terminal rate. I would imagine, right? What would it take to sort of shift that from your perspective?
Yeah, I mean, right now we had the Fed getting back down to neutral, which is also the terminal rate at 3%. Now, for the Fed to have to provide accommodation, well, I think first of all we need to zoom out a little bit, and we had the BLS talk about revisions to payrolls being about 900,000 less than we had initially thought for the 12 months going to March. That's obviously not great because we had less jobs created, but it does mean that productivity was still pretty strong in those months. So if we do have a reversal in productivity, if we have the tailwinds from the one big beautiful bill not be as great, aggregate demand slows down because of immigration, and businesses can't pass along the cost of these tariffs because of demand destruction in consumer balance sheets. And in that case, we would see activity slow down to the extent where the Fed would probably have to provide additional accommodation, and you'd see policy rates go down below 3%. But that's not our base case. But the possibilities of those things happening are certainly higher than we would have normally expected, given the wide bands of confidence that we have on tariff policy and immigration policy.
Thank you for that, Chris. Anybody else have any questions that they would like to post? Just a reminder, if you would like to ask a question live, feel free to raise your hand in the Teams meeting here, and we will unmute you and allow you to do that. Chris, I got one other one for you coming up here. What are the implications of policy given legal uncertainty around Lisa Cook and appointment of Steve Marin?
In the near term, I don't think there are any implications for this. We do have the possibility of a rare 2-sided dissent tomorrow, where you have Myron and Bowman dissenting in favor of 50, and then you have others that are more hawkish, maybe Schmid, maybe Musalem dissenting in favor of 0. But I don't think that the inclusion of Cook or Myron is going to make a big difference. We know exactly where Myron stands, and Cook was never really a swing voter either way. So I think the fact that we might get a 2-sided dissent and a pretty big dispersion in the dots is going to underline how hard it is to manage this committee. And I think that the center is not really far from the reaction function of Powell, but you have the extremes on either end, on the hawkish and the dovish side, having a much more dispersed view than we're typically used to. And I think that's because of the very uncertain effects of tariff policy and immigration policy and what the implications are going to be. But I think that one thing that hasn't been talked about a lot is, are people in the building going to be more hesitant to give a hawkish view and risk that Myron goes back to the executive branch saying, that we have an overly hawkish FOMC. Now, we have no way to know if that's crossing participants' minds, but it has to be asked. This is an unprecedented where you have somebody from the executive branch working at the Fed, only on leave for a few months. So this sort of coordination, as we should say, we haven't seen before. So we don't exactly know how those dynamics are going to play out in the room.
Very insightful. Thank you. Anybody else have any other questions? Again, reminder, you can raise your hand. John, I actually have a question for you. A lot of the listeners are going to be folks that, will be looking to issue potentially paper in the market, and they pay attention to the long end of the market. I know you talked about the premium, increasing and saying, 50 bips isn't sort of enough for where we are at the moment. You have a view in terms of, what is the sort of upper bound of that, or where do you see that going?
It's really kind of a question, where do you think term premium is going to land? And we can't really measure it anyway. So that said, I'm always one to put one in. I mean, I actually if you look back kind of where, just using the Fed's ACM term premium, it's around 75 basis points right now. During the 2010s, it went negative, global savings glut, QE, forward guidance, all these things that repressed volatility, pushed down term premium to historically low levels. Again, I think a lot of that stuff is going away. It's going to be processed more than an event. But I feel like if you get back towards almost where we were in the 2000s, kind of that pre-GFC, post-internet bubble, where you did have some, there's a lot of similarity dynamics, big productivity, tech increases, things like that. In any case, I don't want to go off on that tangent, but I do think like that's probably a decent waypoint. But it's something that is not going to go in a straight line and could take you years to get there. I mean, even post-COVID, we're probably only halfway there. So I think over time, I would put that more in kind of that 1.25% area, if you're asking me to forecast an imprecise, unmeasurable figure. So yeah, so I mean, I think, like I said, it's gonna be a process, not an event, and this kind of thing will be dominated by cycles. If for some reason we have an inflation outbreak, surprising off surge to growth, and the Fed doesn't cut, or actually even has start, or into the next cycle where they're hiking, you're gonna have a flatter curve. It's gonna be dominated by what's going on in the cycles. These are more like headwinds and tailwinds to different parts of the curve. So that's always important to remember also. This is something happening kind of in the background and not the primary driver, which is going to be monetary policy, fiscal policy, and overall the economy.
Well, makes sense, and thank you for providing that guideline. We'll hold you to it. Wanted to just open it up again for any other questions. If anybody else is interested, we can also follow up and send questions over email. And obviously, John or Chris are always happy to jump on the call. At this point, John, Chris, just kind of pinging back to you guys. Do you have any other kind of closeout remarks that you guys would like to have before we finish up?
Yeah, I actually do have a follow-up question for John on that. I just want to get what is your take on the issuance? What do you think Beston's going to do as far as issuing at the front end or in the belly versus the long end? Now, I've got the budget deficit staying at about between 6.5 and 6.8%. So there's going to be no slowdown in the volume of issuance overall. But how much is that increase in the term premium due to the uncertainty about the issuance schedule going out a few quarters? And just wanted to fairly open-ended question on that for you.
Yeah, I mean, I think it's like a sister question, not like the same question of issuance dynamics and term premium dynamics. I mean, but similarly, like the headwind tailwind kind of thing. Nobody really complains about long issuance when the Fed's cutting rates. It's when inflation's high, Fed's behind the curve, like we had a couple of years ago, and Liz Truss moments and all this other. And CNBC has every auction on TV. It's when nobody really the natural buyers start to pull back that it becomes a problem. However, more specifically to your question, I mean, I do think it's pretty well socialized at this point. So how much is priced is always hard to say. But I think that the Treasury next year, when they need to increase coupon issuance, is probably going to shy away from 20s and 30s. I don't think they can cut issuance. The question is, can they issue enough coupons from, say, 10s and in to not issue any 20 and 30 and still have, without creating unnecessary kinks in the curve. But I also like to remind people that if you increase 10s and in by a few billion, like 3 billion, say in the front end, 2 billion in intermediates, and only do 1 billion each in 20s and 30s, on a DV01 risk-weighted basis, it's actually the same. So in order to have like kind of from that perspective influence on try to do like a treasury twist on the curve, I do think you probably have to not issue in the long end, but also that's a flow perspective. From a stock perspective, there's still a huge stock of long duration bonds out there. So I think it would be helpful. I think it would be, lessen a headwind, say, for the long end. But in the end, I think that there's this long run deficit concerns that's going to continue to remain the question of, it's not whether, can they not issue, it's just how much can they issue on a relative basis. So definitely helpful, but I also don't think at this point it'll be a surprise. I mean, one more thing to add is that tariff revenue certainly is helping to push back that timing a little bit. So to the point where can you get past February and into perhaps May of next year? I mean, we'll see what happens with tariff policy. I'm not putting any guarantees on it, but it certainly is helpful on that front, which is also a reminder that when these court rulings are coming up and, if they have to pay tariffs back, there's a curve implication there. But I think that I'm stealing now from you just because I have the mic, the fact is that he's going to, even if these rulings go against him, he'll use other facilities, other, statutes in order to put them back on. So I wouldn't really react too much to if there's a pause in tariff collections.
Yeah, I do think that tailwind from a tariff collection perspective is going to be almost, by my calculations, almost entirely offset by the fiscal loosening from the one big beautiful bill. So it's just preventing any sort of improvement in the debt outlook.
All right. Well, Chris, John, thank you very much for your time today. Everybody on the call, I hope this was informative, valuable. Just wanted to remind everybody, for any of your kind of hedging needs, please reach out to your representative Natixis salesperson. And with that, we'll conclude the call. Happy to answer any questions offline, and we're always here to have a dialogue. So thank you very much, everyone, for joining, and enjoy the rest of your day.
Thank you.